Hello, and welcome to Ducker Frontier webinar, APAC's Industrial Landscape in the Year of the Coronavirus. I'm Sarah Gunnis, Managing Director of Client Services in Asia Pacific. Before we get started, we realize that some of you may be new to Ducker Frontier, so we'd like to take 1 minute to provide you with a very quick overview of our firm and how we work with executives at major multinationals. Ducker Frontier is a leading market intelligence and consulting firm that provides tailored solutions to drive growth for clients across B2B, healthcare, consumer, and technology sectors. Our dedicated teams serve as advisors to clients, delivering the market and industry knowledge they need to succeed at all points in the business cycle. With continuous research and insights, custom solutions, and transaction support services, we provide our clients, a small sample of which you'll see here, with timely and actionable insights to adapt and win to changing markets. Our company is headquartered in Washington, D.C., with offices in Troy, Michigan, New York, London, Paris, Berlin, Singapore, Shanghai, and Bangalore. For more information, please visit www.duckerfrontier.com. Having briefly introduced our company, I'd like to take a moment to briefly introduce our panelists today. We have 3 members of our research team on the line for today's call. The first is Adam Jarzik. He heads the research team for Asia Pacific at Ducker Frontier and will be sharing insights on what he's hearing from our regional executives and China GMs. The second is Pratima Singh. She is our practice leader for Asia Pacific here at Ducker Frontier and will be sharing her insights on South Asia. And the third is Ashu Agarwal. He is a senior analyst at Ducker Frontier and will be sharing his insights on Southeast Asia. As members of Ducker Frontier's research team, Adam, Pratima, and Ashu support senior executives on key initiatives, including strategic planning, resource allocation, and risk management, among many others. Because they are in constant contact with our clients, they will be discussing not only the results of our research, but also what they've been hearing from multinationals who are being impacted by the coronavirus. If there are any insights you see today as part of this discussion or any questions we don't get to answer, my client services team, Raveen, Althea, Yuchen, and myself will be happy to follow up with you directly. With that, I'd like to pass things over to Adam to take us through the agenda.
Thanks, Sarah. Our webinar today will consist of a 50-minute presentation followed by Q&A. To be specific, I'll begin the session with a discussion on how forecasts for growth in Asia are shifting and the assumptions underpinning those figures. I'll then share the outlook for China with a particular focus on the degree to which the country is getting back to work. I'll then hand things over to Pratima, who will share our outlook for India in 2020. She'll discuss the COVID-19 epidemic, or she'll discuss how the COVID-19 epidemic is impacting the Indian economy and highlight key challenges that companies will face in the coming quarters. Once she's finished, Ashu will take the lead and discuss the outlook for Southeast Asia. Specifically, he will discuss the coronavirus's ripple effects on the region and what to expect in terms of recovery across ASEAN markets. We'll then round out the session with a Q&A. So if you have any questions or points of clarification regarding any of the topics that we cover today, please don't hesitate to send them to Ducker Frontier Webinars via the GoToMeeting messenger by clicking on the Q&A box on the right-hand side of the screen. And we'll do our best to ensure that they are addressed in the Q&A period. Now, without further ado, let's get started with the outlook for Asia in 2020. Before we share a perspective on the region and on specific countries in the region, it's important that we take a moment to acknowledge clearly what's happening in the global environment. We are headed into a global recession this year. Major markets globally will fall into contractionary territory over the course of the coming quarters with significant implications for Asia Pacific. You can see that if you look at the chart on this slide. What you'll see there are our forecasts for economic growth by vintage. So the blue bars are the growth forecasts that we had for different regions around the world back in January. The green bars show those exact same forecasts, but back in March, or well, now really, in March. You can see there's been a dramatic drop-off in growth forecasts around the region. And in particular, some of the largest markets, the US and many European markets, in fact, will face recessionary environments in 2020. Unfortunately, the numbers you see here are unlikely to get better. In fact, they're likely to get even worse because they carry substantial downside risk. But even if we put that aside, the impact on Asia has clearly been very negative. Every Asian country across the board has experienced downward forecast revisions. We've seen that not just in many of the smaller markets in Southeast Asia that are oriented towards exports in the outside world, but also critically in many of the largest markets of Asia Pacific, where which executives have previously relied on to consistently deliver results. Those markets have actually been hit just as hard, if not harder. And regrettably, there's downside risk to these forecasts as well, due to rising COVID counts, at least outside of China and South Korea, which are adding substantial uncertainty to the situation. If you take a look at the chart on this slide, what you'll see are active COVID case counts through April 3rd across a variety of markets. The case counts, the active case counts, which are basically the number of cases minus deaths, minus those who are recovered, they've been rising quite aggressively outside of China and South Korea. This, as noted, is introducing a lot of uncertainty. So when we got on a set of pre-wires prior to a virtual executive roundtable we held with senior B2B executives last week, this was a question that really came up time and time again. Our executives wanted to know when we expected various countries to peak, and therefore when we expected various countries to recover. So that's actually why I pulled this data together. I pulled it together because our global economics team built a model that would specifically help us determine when countries would peak. So I sent this over to them, and I asked them to plug the information into their model so we could answer the question for their clients, and they came back with a very interesting answer. They basically said that only China and South Korea provided enough data that had an appropriate shape to be able to make any sort of reasonable predictions. And these predictions are plagued by undercounting, right? They're colored by significant questions about validity and accuracy. But at least for China and South Korea, we could build some sort of model. For most other Asian markets, there was so much undercounting that our global economics team was not even able to make a confident prediction about the size or timelines for their outbreaks. I was a little bit reticent to bring this to market to our clients during the virtual executive roundtable, but it's actually interesting. This view was actually corroborated by one of our healthcare clients during the session. This is an individual who's quite close to the testing environment and the products that are being developed in that space. He confirmed that the countries that we've outlined here don't have enough tests to be able to produce quality data, even if they wanted to. So there's really no way to make confident predictions on these countries. And of course, this conclusion is not ideal. It makes life difficult for everybody because the single most important question we face when it comes to planning is timelines. And without hard data, it's tough to build clear timelines. So what we have to do is make some assumptions. And that's what we've done here. You can see them listed at the bottom of this slide. We have made some epidemiological assumptions as well as economic assumptions. We've assumed that COVID is affected by seasons. That is, that the warmer the weather gets, the less rapidly COVID will spread. We've also assumed that COVID will act like SARS. In other words, that it will die down along the same lines globally. We've also made some assumptions based on what we see happening in economies around the world about recoveries, specifically that China would have a V-shaped recovery, the US a U-shaped recovery, and the EU, we have here down as a V-shaped recovery, but I suspect that's going to change in the next couple of days to a U-shaped recovery. Taking these assumptions together, our current timeline sees the worst of the impact over by the second half of 2020. Specifically, we see China beginning to move back towards normal activity over the March to May period as the US, Europe, Southeast Asia, and India begin to experience the type of production and consumption freezes that we saw in China in Q1. We see the US, Europe, ASEAN, India gradually returning to normal activity starting sometime in June and extending through Q3 at the same time that we may see a possible pickup in cases across the southern hemisphere. Now, it's important to note that there's a distinct possibility that the virus may resurface later this year, much like the Spanish flu did in 1918 and 19. We won't get into this too much here because we don't have time, and most of the questions our clients are asking us concern the first 3 quarters of this year, but this is a serious risk that companies should be thinking about now. So these are our assumptions, and these are the assumptions that we based our forecasts on that we walked into last week's virtual executive roundtable with. But what we wanted to do is test them with the senior executives that we had on the line last week. So we actually took a poll to get their views. We asked them when they expect sales to begin picking up in the markets that they cover. Basically, you can see the options outlined here, everything ranging from we don't expect sales to drop to Q2, Q3, Q4, and then not until next year. And the key takeaway here is that by and large, our executives' views were largely in line with our own. We do expect to see some sort of pickup in Q2 and Q3 of this year in Asia Pacific. And these sort of expectations, these sort of assumptions are not unique to Asia. We asked a similar question in EMEA during a webinar that we held a couple of weeks ago. And basically in EMEA, we saw similar results, except that the timeline was offset a little bit, pushed back towards the latter part of the year, presumably due to the fact that the epidemic hit Europe after it hit Asia. So if we bring this all together, what we see is that in a nutshell, when it comes to Asia Pacific, we expect a V-shaped recovery in China and a U-shaped recovery in the rest of the region. You can see that charted out here where we have economic growth by quarter for a variety of markets around Asia Pacific. So you see China there in light blue experiencing a substantial rebound in Q2 and pretty much everybody else being dragged down in Q2 through the beginning of Q3 by what's happening in the rest of the world before reasonable recovery in Q4. Now, I don't want to overplay this story, the story of China rebounding. China is certainly ahead of many other countries in terms of its recovery, but that doesn't mean that it's fully recovered, and it doesn't mean that there aren't further downside risks. So what I want to do is talk a little bit more about the outlook for China, give you some more detail there. So it is true that China is getting back to work, but as I'm sure you're aware, the story is quite complex because COVID-19 has had a dramatic impact on China's economy. Which you can see this actually if you look at the chart. What we have here is something very similar to what you saw previously with different vintages of data. So in other words, our economic growth forecast for China by quarter for this year in January versus February versus March versus the second round of reforecasting that we did in March as it became clear that the changes were impacting the markets more rapidly than a monthly forecasting cadence would allow us to capture. The growth forecasts for China have been dropping substantially for Q1 and Q2 in particular, which have really dragged down our overarching growth forecast for China. So as I mentioned before, we do expect a rebound in Q2 for reasons that I'll get into in just a little bit, specifically regarding stimulus. However, it's important to note that risks are still tilted heavily towards the downside because the full extent of the global slowdown prompted by the COVID-19 pandemic remains unclear. Let's talk a little bit about this rebound. I mentioned stimulus, but that's not the only thing going on. China is recovering. China is getting back to work. And we see that in government statistics. We see that, for example, if you look here at this chart, a result of business activity surveys released by the Chinese government. You'll see that to a large degree, certain aspects of the economy have moved back towards renormalization, right? The quote unquote work normalization rate for state-owned enterprises and state firms is, according to Chinese official statistics, approximately back to where it was before, as is the logistics capacity of China. Infrastructure projects are working back towards normalization. Things are moving in the economy. But the story is not quite as rosy as the official narrative would have you believe. I'll highlight just a couple of things here. The first is that private companies are clearly lagging behind state-owned enterprises and state-linked firms. You see that reflected in the fact that the work normalization rate for SMEs is much lower than that for state-owned enterprises and state firms. This is problematic because SMEs, private enterprises, are the ones that really provide most of China's jobs. The second thing I want to note here is that it's very important to take these statistics with a grain of salt. For example, the quote-unquote work normalization rate is not necessarily an indication of capacity utilization. It's more an indication of what percentage of companies are back in operation. We see that as well for infrastructure projects, for example, where yes, a lot of projects have restarted, but they're not quite back up to the pace of development of work that we saw prior to the epidemic. As a result, it's probably fair to say that you got to take these statistics with a grain of salt. And so to get a better idea of what that looks like, we actually took a poll of the executives that we had on the line during our virtual executive roundtable last week. We asked them to what degree they see Chinese companies' work normalizing. You can see the results here. Basically, if you look across the chart from left to right, you see the 100% down to 10%. And so you'll see that Chinese companies are normalizing, according to our executive poll. But they certainly are not back up to the levels that the Chinese government claims. Normalization for SMEs of above 75% and a normalization rate for state-owned enterprises and state firms of 99%. If we were to consider this a probability distribution, then it indicates that companies in China's work is normalized to a level of less than 60%. Of course, it will get better in the future. Things are moving in a positive direction, but that's a far cry from the claims that are being made by the Chinese government. And unfortunately, the road back to normalization will be a challenge. Export orders, falling export orders will continue to weigh on manufacturing activities in China. You can see this if you look at the chart on the slide in front of you. So there you should see the official purchasing managers sub-indices for new orders and new export orders outlined in light blue and dark blue, respectively. Basically, with purchasing managers, these purchasing managers sub-indices work the same way as purchasing managers index does. If the line is below 50, it means that it's in contraction. If it's above 50, it means it's an expansion. If it's at 50, it means it's neutral, right? What we see is that domestic orders recovered much faster than export orders in March from a dramatic low in February. And unfortunately, new export orders are still in contractionary territory and will probably remain in contractionary territory in the coming months. That's basically just because there's so much external weakness. And so with this in mind, we recommend that companies active in China target clients with domestically focused supply chains and customer bases, because they're likely to experience a more rapid recovery marked by less volatility over the course of the coming months. Now, it's important to note that the issues that China faces with exports are not exclusively due to weakness in external demand. They're also due to bottlenecks in airports and seaports around the country. During our pre-wires for the virtual executive roundtable, numerous executives we spoke with highlighted the difficulties they were facing on this front, whether it was getting critical inputs into the country for their factories there, or moving finished products out to clients internationally, or both. And one of the questions that kept on coming up was, when will this end? So we asked our clients on the line during our executive roundtable, when will the bottlenecks in China's airports and seaports ease? And this is the response set that we got. You can see that basically we have responses by month out until J, which is not until 2021. And thankfully, no one was talking about 2021. No one was even talking about Q4. Instead, the executives we polled believe that the logistics bottlenecks in Chinese ports will ease at the end of Q2 or in early Q3. Now, personally, I orient towards the latter of those two options, but even if it's the former, even if we see logistics bottlenecks in Chinese ports begin to ease at the end of Q2, companies will still face the prospect of several more weeks of major bottlenecks, impacting their ability to get key inputs as well as serve clients internationally. Now, hopefully before then, we should have a better idea of what's going to happen in the domestic economy. Hopefully by then we'll have some good news that will help to bolster growth, particularly for companies who are serving companies who are focused on the domestic market with domestically focused supply chains. We believe that there is a stimulus package in the works in China that will provide a substantial growth rebound in Q2 and should help companies that are oriented in that direction. So it's a little bit difficult to get into details on what this is going to look like because the Chinese government has been a little bit cagey about its intentions on this front. Cagey is the wrong word. The government just has not released that many details. The Xi administration is being cautious. It doesn't want to be pulled back into a situation where it's going to end up spending huge amounts of money, particularly during a time when debt is proving to be such a major challenge. And so it's trying to strike a balance and trying to be thoughtful about the approach that it takes. But we believe that the Chinese government's approach is likely to fall somewhere along a spectrum between investment-led and consumption-led stimulus. So that's, we tried to capture that in the slide that you see on this screen table that basically lays out what that means. Because when most people think about Chinese stimulus being investment-led, they think about the country plowing money into road, rail, infrastructure, port infrastructure, major fiscal stimulus projects that are incredibly labor intensive in order to drive growth, kind of like it did back in 2008, 2009. That's probably not what's going to happen this time around. Instead, an investment-led infrastructure stimulus package would be more oriented towards the industries that China sees driving its future growth: 5G infrastructure, the industrial Internet of Things, healthcare infrastructure. Less labor intensive, more forward-looking projects, or projects, which would probably be dominated by state-owned enterprises and funded through government bonds and bank loans via the central and provincial governments. We do expect to see some of that, although we also expect to see that complemented to some degree by more consumption-led policies. Vouchers, subsidies provided by provincial municipal governments which should help private firms and small, medium-sized enterprises and should benefit companies selling into clients in the consumer durables and consumer staples space. As I mentioned, it's going to be a little bit of time before we see what that looks like, but you should watch for announcements coming out of the next Liang Hui meeting. It's also called the Two Sessions meeting, which we expect to happen later this month. That's when we should see details come through. So with the final piece of the puzzle in place, we can now turn to our expectations for different industries in the Chinese economy over the next few quarters. What you should see on your screen are a variety of different sectors, color-coded in terms of whether they're experiencing substantial disruption, recovery, or a return to normalcy over the coming quarters. Basically, if I were to break this down, we expect to see industries that are shielded from the external environment, that benefit substantially from stimulus, and that are less impacted by consumer sentiment to begin recovering in Q2 and experience something of a return to normalcy in Q3 and Q4. We expect other industries to begin recovering soon thereafter in Q3, with one exception, that is the automotive industry. Regrettably, we expect the automotive industry in China to take longer than other industries to recover this year due to weakness that predates the COVID-19 outbreak. And so with this in mind, we suggest that to maximize revenue upside in the market, B2B firms prioritize customers and industries that are poised to recover quickly and that are poised to remain resilient in the coming quarters. In other words, the segments, the sectors that are outlined there with just one set of red boxes. We recommend companies deprioritize the automotive industry as and when it is possible to do so, unless you have a very specific reason to continue targeting specific segments within it. Now, all of this, of course, is based on the assumptions that we laid out earlier, that there will be no resurgence in COVID in Q4. But by and large, we expect this pattern to define the rest of the year. So with all that being said, I'll wrap up China now and turn things over to Pratima, so she can take us through the outlook for India.
Thanks very much, Adam. Let's move on from one major market to another, but one that's at a very different stage of this COVID-19 outbreak at this point. While China is sort of getting out of it, or at least aims to recover a little bit, India is very much in the throes of it all at this point. As you see on your slide, the Indian economy was not doing well before. So all of 2019, we saw extreme weakness in the Indian economy. However, what's happened in 2020 is much worse. So our view for India's outlook for 2020 is, in fact, the weakest it's been in several years, possibly since 1947, which was when independence was provided to India. So extreme weakness in the Indian economy. And this is because all of the main drivers of growth, specifically investment, both government and private investment, are extremely weak. We expect this to go down to negative territory this year. Consumer spending is also very weak. India is a very consumer or consumption-driven economy, 1.3 billion people. But given the way that this COVID outbreak is actually playing out in the country, we expect that consumption will also be extremely limited. Exports, of course, because of the way that the global economy is sort of shaping up, weak demand across major export centers for India, the US, Eurozone, even Southeast Asia, we're seeing exports negative as well. The only sort of silver lining, or the only positive, slightly positive as well, we were very cautious in our optimism, is government actions. We'll talk about this in just a little bit in more detail, but essentially government action in terms of containment and and just measures to control the spread, but also government action in terms of providing a stimulus. Now, the reason we bring all of this up right now and take a step back before we jump into the specifics of the COVID outbreak is because we know it's a strategic planning time for you in different companies at this point. And as a result, understanding what are the assumptions that you're making for the outlook for India, how this is going to shape up in 2020, planning for contingencies, because obviously this is a market that's very much at risk even today, is going to be critical. It's very important to align with local teams, and we'll talk specifically about some timelines for recovery that will be critical to test with local teams as well. Now, before we jump into that, let me just give you a quick update on what's happening with the COVID-19 situation, because that's really, sorry, Adam, if you could just go back to the main page still, because that's really critical in terms of understanding where we are. So when we presented this page to our executives at the virtual executive roundtable last week, the numbers for India were still relatively more contained. It was about 4,000 cases reported, and this is, keeping Adam's comment in mind, entirely underreported. Luckily, testing is picking up, and of course, the spread as a result is also increasing. India now has between 9,500 and almost 10,000 cases of positive cases of COVID reported. It also has a large number of deaths, about 320 or north of higher than 320 deaths as of today. Now, this is important because today is in fact the day that the lockdown measures, the nationwide lockdown that the government imposed, was supposed to be lifted. The lockdown is likely to be, the Prime Minister Modi, is going to be coming and giving a speech at 10 a.m. India time, which is in another 2.5 hours or so. And it's very likely that this is going to be extended. It's possibly almost certain that it's going to be extended nationwide till the end of April, with some states, those that are most affected, like Maharashtra, Tamil Nadu, Punjab, Telangana, and Orissa, likely to extend this even further. As a result of this lockdown, as a result of the spread of the virus in India, we've substantially revised our 2020 numbers down. We had it, as Adam showed you in the earlier section, in January, at the end of last year, in January this year, we had it at 5.8%, still very low for India. India, it should be, given the size of the population, the number of people entering the workforce, India should be growing at 8% to just create jobs for its 1.3 billion people. We have revised our number from 5.8% growth for 2020 down to 4.9%. And then in the first March vintage, we did it down to 2.3%. And as you can see on your screen here now, it's down to 1.3% growth for 2020. This is expected to improve only very marginally to about 4.3% in 2021. But given the way that things are playing out, the risks continue to remain very much to the downside. Now, Adam, if you could just move to the next page, please. We did want to highlight what our view is for recovery, because the risks are definitely to the downside. Companies should be preparing for contingencies in India. It is a market which is very much at risk. But if our base case scenario plays out, and by that I mean assumptions around containment efforts concentrated largely in Q2, so playing out all of April, spreading into May and possibly even June, and then the gradual economic recovery basically starting at the end of Q3 and feeding right into Q4. So as a result of that, given those assumptions for domestic economy, global economic recovery, as well as containment efforts and government stimulus, we see the maximum impact of the COVID-19 situation as a result of lockdowns concentrated very much in this quarter, so the April to June quarter of 2020. We're forecasting a dip, a contraction of -3%. We expect that next quarter, July to September, this improves a little bit, going up to 1%. And then at the end of the year, going into 3% growth. This is, again, like I mentioned, very low, but what is critical to understand here is that the brunt of the impact will be contained this quarter. As a result, it's 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 imperative to align with headquarters and local teams to be able to understand whether this is in fact part of their assumption. Are they understanding exactly how they're setting targets in response to some of this shock that is playing out in the Indian economy, and also managing communication with headquarters in being able to understand the growth trajectory that the Indian economy is on. All right, Adam, if you could move to the next page, please. In keeping with what Adam showed you as well, some results from the polling questions that we asked our executives at the B2B virtual executive roundtable, we also asked whether what would be the most significant disruption to their India business in 2020. And as you can see, out of all the options, the one that really sort of stood out, 33% of our executives said lack of demand remains the main disruption and the main challenge for companies in India in 2020. Now, this is because, of course, lack of demand and a general slowdown in the Indian economy was already taking place. But the COVID-19 situation has just exacerbated a lot of that slowdown and, in fact, led to contraction. As a result, most multinational companies that are selling to customers in India are likely to see a reduction in demand and possibly just an entire wipeout of demand, specifically in Q2. The second big disruption in India is following the lockdown measures. And so we've seen factory halts and factory shutdowns and production halts in India as well as a big disruption. While we were doing the pre-wires for our event, we actually spoke with several companies, some in the chemical space, but also in diversified industrials. They were talking about how, given the fact that this lockdown was so sudden and, to be very honest, not entirely well executed, their operations managers on the ground were struggling to really shut down factories in a safe and effective way. They were trying to get to the factories, dealing with police on the way in order to just get to their facilities and actually make sure everything was shut for a month going forward. So, as is the case with India, it's very critical to understand the policy intention might be great, but the repercussions and the execution of it will still be lacking and wanting, to be very honest. And as a result, production halts continue to be a big disruption in India. Logistics and movement of goods, as well as payment delays, two, I guess, challenges in India that are, to be very honest, quite perennial, will continue in this environment going forward as well. Adam, if you could go to the next slide, please. I wanted to quickly show you some survey results from the Reserve Bank of India, the Indian Central Bank's Industrial Outlook as well, to really highlight how this has changed in a matter of, honestly, just a week or two. So the bars, the light blue bars that you see, are responses from the business community, highlighting their view on different, I guess, aspects of industrial production before March 20th. So a positive number indicates a certain level of optimism, and a negative number indicates pessimism, and the range is from 100 down to a negative 100. So before 20th March, executives on the ground were more or less a little bit cautiously optimistic about the overall business situation. Capacity utilization was also pretty fair. Everybody was expecting a gradual recovery in the Indian economy. Following the COVID-19 situation, and in particular following the lockdown measures, we saw that this went 180 degrees. We saw overall business situation drop down to negative 35, capacity utilization down to negative 40, and production, as we saw from the polling results as well, go down to negative 38. Essentially, we're seeing a slowdown across different facets in the Indian economy for B2B companies, making it a very, very challenging time in India for the next quarter or two. The other side of the story, which is again an internal challenge in India, is surrounding payments. So Adam, if you could move to the next page, please. We pulled together some responses from small, medium companies on how challenging it is to receive payments from customers in India. This is going to be an issue that is exacerbated as a result of COVID-19. Across the globe, we're seeing liquidity challenges emerge. People are hoarding cash. Credit is very, very tight. But this has been a situation in India for several months and maybe even years now. And this is only going to get worse. Even in normal circumstances, you'll see from the visual on your left-hand side, SMEs generally find it very difficult to plan their payment cycles in India. At best, companies can get money back from their customers within 15 days, but you'll see it's only a very small percentage, 9%. The most common response was unpredictable. 44% of companies said that they are not sure when they can even plan to get their accounts receivable from their customers. And that creates significant challenges, particularly in an epidemic situation, the way it's playing out in India. And this is also something that's reflected across the board. You'll see that from large private sector companies down to government and even other SMEs, it's very difficult for companies to get money back from customers. And this is something that's reflected even from our conversations with large multinational companies. Getting money back from large private players in India and even the government has been especially challenging. And now with the way the government has injected stimulus in the market and it's already running a very tight budget deficit, and of course the credit environment is pretty unfavorable for any private sector company, we're going to see this get even worse going forward. All right, I do know that I'm very cognizant of the fact that I've created a very grim picture, but what is going to be critical in determining success in India going forward is really prioritizing different customer segments and looking for resilient sources of demand in a very slow economy. And this is something that we've tried to put together here as well. As you can see, we've laid out the outlook for different sectors and different, I guess, industries, and also how this is going to play out by quarter in India. So, of course, consumer staples is the first to recover. Construction, whether it's for real estate or infrastructure, is going to remain quite weak all the way through till Q3, with only infrastructure investment picking up slightly in Q4. And this is again determined only by the government's willingness to really sort of drive any kind of public investment in infrastructure going forward. As Adam mentioned, our view on automotive remains very, very weak. This is, of course, because the automotive sector is dealing with its own issues, but India is no exception. The auto sector remains very, very weak going forward for the rest of 2020 as well. All right, so I guess I did want to highlight that it's going to be critical to understand your customer segments, prioritize which ones are going to be recovering first, working with your customers, working with your distribution partners on understanding the payment environment in India, and also working with your local teams to really understand the recovery that's likely to play out and also align on timelines, as a result of which your targets would be affected going forward. With that, after this very grim picture that I've painted for India, I do want to sort of move things over and hand it over to my colleague Ashu Agarwal, who will highlight our view for ASEAN going forward.
Thank you, Prathama. Well, with Southeast Asia being in a more similar position to India, the COVID-19 situation in this region is surely very much still developing. With that in mind, we would like to dive straight in and look at what we expect the impact of the COVID-19 situation to be on the high-level GDP figures in the region. First of all, by just looking at this figure, you can see that we expect significant disruptions in the Southeast Asian countries. Thailand's economy is likely to be most significantly affected, and that's to a certain extent is because of its dependency on tourism. Tourism accounts for approximately 20% of the overall economy, 15 to 20% of the overall economy, and that will surely have a significant impact on the economic performance of the country. But apart from that, the Thai economy is also quite dependent on exports, and particularly that of key exports which go into major economies such as the US and Europe, China, and some of the other Northeast Asian countries. A lack of demand from those countries will also significantly impact growth in Thailand, resulting in a significant downward revision in our outlook for the economy. The second, where we expect a pretty significant decline, is also Malaysia. That once again is because of Malaysia's dependency on exports, particularly of certain key commodities and electronics and electronic components, and also because of a nationwide lockdown, which was implemented because of a significant rise in the number of cases. The significant number of cases has hence resulted in a reduction in domestic demand and has also affected overall business and industrial activity. This has hence resulted in a pretty significant revision in our GDP expectations for Malaysia. And thirdly, another major country to highlight is Indonesia. You might notice here that the downward revision for Indonesia is not as significant as we've made for many of the other Southeast Asian countries. But that is largely because we still expect a really significant impact on Indonesia, but for that impact to be relatively more spread out. And hence, Indonesia will not just experience an impact from the COVID-19 situation in 2020, but a lot of that impact will also be spilled over to 2021. And hence, even though the overall impact is expected to be significant, the impact might be relatively lower in 2020 with significant spillover effects into 2021. Nonetheless, we see that each economy has seen significant downward revisions, and we expect to make further revisions as governments take various policy actions and the outlook of major global economies changes. On the next slide, we take a step further from just the high-level GDP numbers and look at the key channels through which the Southeast Asian countries are being impacted. These channels could be useful in identifying the impact of the outbreak, not just in economies, but also more specifically on your company. First channel is lockdown. Lockdowns are likely to most significantly impact companies which have production plants in these countries. Lockdowns will, of course, also create issues related to lack of demand and payment delays. However, companies who have manufacturing operations in these countries will not only experience a disruption in supply to domestic demand, but also a disruption in supply to external markets, as companies often establish manufacturing in these countries for the purpose of exports. Trade is also a channel through which many of these countries are likely to face significant disruptions. If your company sells to a wide range of manufacturing industries, you're more likely to be selling to an export-dependent customer in Vietnam than in the Philippines. Just to give you an example, approximately 20% of the Philippines' industrial base is dependent on exports, whereas approximately 45% of Vietnam's industrial base is dependent on exports. And so this overall just highlights the significant difference in the dependence on exports across these countries, and also how significantly they will be affected by this particular trade channel. The third point is domestic spread, which will also have a very significant impact on the overall economy and particularly on domestic demand. With the spread being significant across most markets, domestic demand will likely dip across the region. In the case of Vietnam, we do believe that the number of cases currently are being underreported. However, we also believe that the early action by the government means that it is better prepared to contain the virus, and that will reduce the overall impact compared to some of the other countries in Southeast Asia. And finally, we have the positive driver, which is fiscal stimulus. We have seen many Southeast Asian countries implement significant stimulus packages. This will help support the overall economy. It would be useful for companies to evaluate the stimulus packages in key markets to identify any financial support that they might be able to take advantage of, and particularly also identify financial support available for distributors, as many of the measures are geared towards supporting small and medium-sized enterprises. Apart from that, the companies which will most be able to take advantage of any fiscal stimulus measures that have been put in place will be companies who have manufacturing plants in these countries, as several countries, particularly such as Indonesia, have announced support measures for manufacturing operations in the country. One of the key concerns of ASEAN-focused executives at this point in time is also the recovery in the performance of the Southeast Asian countries, which we've highlighted on the next slide. And that is what we have. We expect the most significant economic impact to be felt in the second quarter of the year. And that is due to large-scale lockdowns, which will impact practically all sections of the economy. If we focus on the third quarter, we expect Malaysia to experience the quickest recovery, as it implemented its lockdown relatively early, and it's also better positioned to contain the virus due to its better developed healthcare system and also relatively better access to testing kits. Looking into Q4, we expect many of the Southeast Asian countries to start seeing significant signs of recovery. However, as I mentioned before, Indonesia is likely to make only a gradual improvement due to limited government containment measures. And this will mean that the impact of the virus will spill over to 2021. The Indonesian government is quite concerned at this point in time of the financial burden it will put on the government if it imposes a lockdown. And this resistance in imposing a lockdown means that the overall spread of the virus is likely to be much higher in Indonesia than in the other countries that have currently implemented a lockdown. And hence, this will have an impact on the recovery of the Indonesian economy. Hence, what we can see here is that we expect growth in the fourth quarter in Indonesia to still be lower than the growth experienced in the first quarter, as the country only makes a gradual recovery. On the next slide, we also have the impact of the COVID-19 situation on various industries, as was also highlighted for China and India by Adam and Prathama. We expect the overall impact to be quite uneven. In Q1, most industries expected experienced at least some disruption due to lockdowns, decline in external demand, and also supply chain disruptions. Most industries are expected to take the most significant hit in Q2, as a lockdown pretty much across the region brings most industries on a standstill. And in Q3, we expect a gradual recovery across most industries. However, we expect the quickest recovery in infrastructure. Governments in Southeast Asia have announced substantial stimulus packages and have decided to fund that using increased debt, rather than relocating funds away from infrastructure development. And so as lockdowns are lifted, we expect governments to quickly start ramping up investment on infrastructure. And also for other major countries that have been involved in the infrastructure development in Southeast Asia, such as China and Japan, to also experience some level of recovery by then, and for them to also start ramping up investment in this region. Hence, overall, as lockdowns are lifted, we also expect governments to quickly start ramping up those investments. Finally, in Q4, we expect most industries to return back to normal. However, the automotive industry, as we've also seen in the case of China, and India, will continue to face some disruption as many production units have shut down permanently. And also, there will be significant disruption in real estate construction as many companies have high levels of debt, particularly those in Indonesia, which along with having high levels of debt, have very high levels of US denominated debt. As a lot of currencies in Southeast Asia are facing significant downward pressure and are depreciating, it will further increase the burden on servicing that debt and will have an impact on the operations of these countries. And finally, on the last slide, we have the survey results very similar to the question that we asked on India from our most recent virtual executive roundtable, which was about which of the following will most significantly disrupt ASEAN businesses in 2020. And what you can see here is that most of the responses are linked to the lockdowns that are currently in place. The most significant challenges faced by companies right now are factory shutdowns, production halts, and also a lack in demand. And to a certain extent, companies are also facing challenges related to logistics and payment delays. As lockdowns are gradually lifted across markets after a few months, we expect these challenges to shift gradually. Challenges such as personnel management and regulatory compliance will become more important as countries implement and governments implement various different safety measures to ensure that the virus doesn't start spreading again once the lockdowns are lifted. And so executives need to start preparing for some of those other challenges which are likely to start becoming key in their operations in the next few months, apart from the major challenges that they're currently facing right now, which are linked to the lockdown. With that, I'll pass the time back to Sarah.
Thanks, Ashu, Adam, and Pratima. Those were very interesting insights. We'd now like to begin the Q&A portion of this webinar. Just a reminder, if you have any questions, please do share them with us via the GoToMeeting Messenger by sending your questions to Ducker Frontier webinars. So we have quite a few questions coming through. If you have a few minutes to stay on with us, we'll try to get those answered. The first one is maybe for Adam. The first one coming through is, how great is the risk that coronavirus resurfaces later this year?
In a word, the risk is significant. And I say that not as an epidemiological expert or as somebody with extensive knowledge in public health, but as somebody who understands that we really don't know what this virus's pattern is going to look like. Nobody does. This virus could look like SARS, as we've assumed in the timelines laid out earlier, whereby it basically escalates over the course of the first couple of quarters of the year and then dies out, such that by the second half of the year, it's not really causing nearly as much damage, and there is no reemergence. Alternatively, it could look more like the Spanish flu, which boomeranged around the globe multiple times, leaving waves, or leaving in its wake devastation, really, after several waves. We just don't know at this point. It could look like one of those two things. It could look, or one of those two flus. It could look like something else entirely. And so, given the uncertainty, it's imperative that companies engage in scenario planning in order to prepare for a variety of potential futures. What exactly those scenarios look like will vary to some degree by company, but we would strongly recommend that executives begin aligning around a set of scenarios that include a potential resurgence in Q4 of this year in the Northern Hemisphere, and potentially additional waves of the virus next year. That would be the prudent thing to do in order to safeguard your business moving forward.
Thanks, Adam. That's certainly very interesting and very good advice. I think we've seen a lot of our clients start to take on those different scenarios within their own businesses. Moving on, I think maybe we can spread this out a little bit and share a question coming through for Pratima on India. What would happen to the Indian economy if the Indian government is unable to contain the outbreak in the next few months?
Thanks, Sarah. Well, I guess the short answer to that question is the economy would most certainly go into contraction. In fact, speaking of scenarios, I'm going to take a cue out of Adam's book. Adam, if you could just maybe move to the scenarios that we've laid out for India, I think it would be helpful to show our audience. Essentially, what we've done, because the risk in India remains very, very clearly to the downside. In our base case, we've made a couple of assumptions on how this is going to play out, and all of the numbers, all of the analysis that I showed you really talks about the base case, whether it's containment in Q2, some spillover into Q3, with significant weakness in the domestic economy in the next 2 quarters, and then some gradual recovery starting from Q4. The likelihood of that is about 60%, which means that to answer your question, the likelihood of a downside risk is still very high at about 25%. And that's where we've explicitly assumed that the containment measures are going to basically not be effective, at least the ones in Q2, and they're going to drag on well into Q4, which means that basically through the next 2 quarters, we're going to see in different shapes and forms the Indian economy, different states, whether it's nationwide or statewide, lockdowns across the country. that's going to significantly disrupt business, whether it's through production halls, but more critically through movement of goods and logistics. And of course, that's going to be something that we've already started seeing happen in just this 21-day lockdown, but that's going to be continued on till the end of the year if the government is unable to contain the spread in the next few months. That's going to have a massive impact on consumption, private investment. We're going to see all of those different, components of GDP contract, and we're going to see this play out even next year in 2021. The likelihood, honestly, we keep revising our scenarios and we keep going further and further down. But I guess to just tie all of this with a bow, our numbers then for 2020 in our downside scenario would go into negative 4.5 to negative 5% contraction in the Indian economy if the government is unable to contain this in the next few months.
Thanks, Pratima. That's certainly something to watch for the Indian economy. We've got a lot of questions coming through and just a little bit of time. So if you can maybe stick around for one more question, I'll throw this one over to Ashu. Ashu, how large are the fiscal stimulus packages in Southeast Asia? And will they provide significant support to the ASEAN countries moving forward?
Good question, Sarah. When we look at the various different stimulus packages, they really range, the sizes really range across different economies. So the most significant one comes in Malaysia, which has introduced a stimulus package which is equivalent to 18% of its GDP, which is very, very significant. And it will surely provide support to the overall economy. However, it is important to also note at this point that a lot of these stimulus packages are mainly aimed at supporting the low-income population. And if they're supporting businesses, mostly targeted towards manufacturers or small and medium-sized enterprises. And so even as they provide some support to the overall economy, it would be important as companies evaluate these fiscal stimulus packages to see if there is any possibility to take advantage of support measures, and might be more important to actually focus on those measures which will help the distributors to stay afloat so that they don't face go into bankruptcy or face significant financial disruptions, which has significant long-term effects.
Thanks, Ashu. That's definitely good advice for our clients on the line. Well, we're already over the top of the hour, so I appreciate everyone sticking around to hear some of the additional questions that were coming through. But I think we have sort of hit our limit for today's webinar. If there are any questions that we were unable to answer or that you haven't been able to get through to us, we'll be sure to follow up with you, or you can also reach out to your client relationship manager. Before we conclude, I just want to ask Adam if you have any final remarks you'd like to share.
Thanks, Sarah. We'd like to conclude the session for today by highlighting several key takeaways that were outlined throughout the session. So here are 7 suggested actions for you to take following this call. First of all, plan for a gradual recovery in China in Q2 and a gradual return to normal activity across Asia in Q3. Additionally, begin building contingency plans for a situation in which the virus resurfaces globally, particularly in the Northern Hemisphere in Q4. Where possible in China, target companies with domestically focused supply chains and customer bases. These companies are likely to experience a much more rapid recovery marked by less volatility over the course of the coming months. Number 3, watch for announcements coming out of China's next 2 sessions meeting, the Lianghui. That's when leaders are going to announce stimulus package details, or at least that's when they're likely to do so. Number 4, reevaluate targets and prepare for continued uncertainty in India, as significant disruptions in production and supply chains will continue even beyond the lockdown period. Number 5, in India, work closely with your distribution partners and customers to manage working capital and liquidity because they're operating in an already tight credit environment, and the current situation is just going to make that even more challenging. Number 6, reprioritize markets in Southeast Asia for 2020 to take into account the impact of COVID-19, which is expected to vary substantially across countries. And finally, anticipate deceleration in manufacturing activity across Southeast Asia and evaluate the impact that this will have on your customers' financial positions.
Thanks a lot, Adam. Appreciate you rounding out our session today. Thank you everyone for joining. That does conclude the webinar for this morning. We look forward to hopefully speaking with you all again soon. Take care and be safe.